Today, we're digging deep into the printing industry. We're going to look at the 2025 financial reports from three of the biggest names out there: HP, Canon, and Sindoh. And believe me, the story we found is about way more than just ink and paper.
So, let's get right to it. Is printing dead? I mean, that's the question on everyone's mind, right? We hear about the paperless office all the time. And honestly, if you only looked at the raw hardware sales numbers, you might think the whole industry is about to pack it in.
For instance, check out HP. Their printing revenue dropped by 3.7% in 2025. At first glance, you see a number like that and think, yep, case closed, it's declining. But then you see this number. That same year, HP's total revenue was a staggering $55.3 billion. That tells you there's a much, much bigger story happening here.
So, the real story isn't about the death of print at all. It's about a massive transformation. The game has totally changed. It's not about just selling boxes anymore. It's all about shifting to digital services, subscriptions, and these really smart integrated solutions.
So how exactly are these giants evolving? Well, when we analyzed their 2025 reports, we found three completely different game plans for this new world. And as you're about to see, some strategies are working a lot better than others.
Okay, so here's the bottom line from our analysis. These are the final risk ratings. We've put Sindoh in the highest risk category. There are some serious red flags there. We're keeping a cautious eye on Canon, and HP, despite some headwinds, looks relatively stable. Now, let's break down exactly how we got here.
To really get a handle on the risk, you first have to understand what each company's trying to do. They're not just competitors in the same race. You could almost say they're playing entirely different sports.
So we gave each one a persona to capture their strategy. Think of HP as the cash cow gambler. They're using the massive, reliable cash from printing to make huge bets on things like AI-powered PCs. Then you have Canon, the diversified fortress, leveraging its incredible tech in really profitable areas like medical and industrial imaging. And then there's Sindoh. We're calling them the House of Cards, basically just trying to defend their turf in a market that's shrinking.
So, what does this all look like when you check the numbers? Well, these strategies show up pretty clearly in the financial data, revealing some obvious strengths and some really worrying weaknesses.
And boom, this chart says it all. Just look at Canon's gross margin, almost 47%. That is the power of selling high-end, high-value stuff like medical scanners and semiconductor equipment. Now compare that to HP, way down at about 20%. You can just feel the intense price pressure they're facing in the consumer market.
Okay, let's talk about a key metric: inventory days. You can think of this as kind of like the pulse of a hardware company. It's simple. How long is a product sitting in a warehouse before someone actually buys it? If that number starts creeping up, it's a huge warning sign that demand is slowing down.
Which brings us right to Sindoh. In 2025, while their revenue was actually falling, their inventory of finished goods, printers sitting in boxes, went up by a mind-blowing 155.5%. That just doesn't add up. And here's the kicker. It's not just us noticing this. Their own external auditors publicly flagged a relatively high inherent risk with their sales numbers. They're worried about something called channel stuffing. That's when a company pushes tons of product to its distributors to make its sales numbers look good, even if nobody's actually buying the stuff. Now let's put that in perspective. Look at the other two. HP's inventory days ticked up a little, from 63 to 66 days. Okay, so they're feeling some pressure, but it's nothing crazy. Canon, on the other hand, actually got more efficient. They shaved 2 days off their inventory time. That's a sign of a really well-run operation.
All right, let's talk about something that looks a little weird on HP's balance sheet: negative equity. Now, this sounds really bad, right? It's like you have a great salary, but your debts are actually worth more than your house, your car, everything you own. But for HP, this is deliberate. It's a core part of that cash cow gambler strategy. They make so much cash, they just immediately give it back to shareholders instead of building up a pile of assets. Okay, next up, R&D. If you really want to know what a company's vision is, don't listen to what they say. Look at where they're spending their research and development money.
And the difference here is just staggering. It's night and day. Canon and HP are pouring billions of dollars into inventing what's next. And Sindoh? They're spending just over $2 million. This isn't just about size. It's a fundamental difference in ambition and vision for the future. And look at where that cash is going. Canon and HP are on offense, investing in huge growth areas like AI, medical tech, and software for hybrid work. Sindoh's R&D, what little there is almost completely defensive.
It's basically just enough to keep the lights on, maintain their old products, and meet some new environmental rules.
So, let's pull all these threads together. After looking at the different strategies, the hard financial numbers, and where they're placing their bets on the future, we can circle back to those risk ratings with a much, much clearer understanding.
So for Canon, that fortress is strong, but we're keeping an eye on their medical division after a big write-down. For HP, that massive cash flow makes them stable, but their low margins mean a big market shock could really hurt them. And as for Sindoh, that house of cards, well, there are just too many red flags to ignore, from the inventory pile-up to the auditor warnings. That's why they get our highest risk rating.
Now, we've just scratched the surface here to give you the strategic big picture. If you want to dive in and crunch all the numbers for yourself, the complete, detailed data set is available over at HDIN Research's website.
And that really brings us to the most important question, doesn't it? The game isn't about selling boxes anymore. It's about selling intelligence. In this new age of AI, the real question is, who's got the right strategy, not just to survive, but to actually thrive? That's what we'll all be watching.